Hi, this is Josh Olszewicz from Canary Capital here at the Nasdaq with a special macro report. Today we're going to discuss inflation charts, all things macro. I usually start the day looking at the economic calendar for the week. This week we have, of course, the usual FedSpeak, just loaded with FedSpeak. I'm looking at Thursday, a bunch of FedSpeak, Friday, a bunch of FedSpeak. Now what's going to be more important here is obviously the Trump tweets, truths, and the war, but the FedSpeak around rate discussions is also going to be highly scrutinized under a microscope because as we look at the Fed funds futures at the Fed Watch tool from the CME, we can see we've priced out all cuts for the year. Going into this year, we had priced in 2 to 3 cuts, and at this point, we're pricing out cuts almost completely until 2028. Obviously, we have Warsh coming in May, and he has been famously a dove under Republicans, a hawk under Dems. It's going to be interesting how he's going to twist himself into a pretzel discussing this current macro environment. And wouldn't it really be something if Warsh comes in and ends up hiking rates on Trump? Probably unlikely, but certainly possible. One of the first inflationary metrics I like to look at as well is truflation. Truflation gets a lot of flack from a lot of people. It is a real-time measure of many data points on the internet, and it's aggregating an inflationary metric. It's different than CPI, but it is also more sensitive than CPI. And currently it is rising again from a trough of below 2%. And if we look at the rate of change is really the most important thing, because at this point we're seeing a pretty steep rising rate of change after kind of a quiet period, sub 2%, sub 1%. And this was even after the tariffs. So despite CPI not incorporating this disinflationary impact or deflationary impact, truflation did, respectably. And all of those gains in the disinflation at this point are being erased on the back of the oil shock in the Middle East, the war in the Middle East, the uncertainty in the Middle East. So seeing my favorite inflation metric flip from sub 2% to now 1.74 and rising is certainly not a great feeling, as I was cheering on the nowcast, which had also, from the Fed, had also been sub 2% or headed to sub 2%, on its way to sub 2%. And now we have the CPI estimate for March at 3.16, PCE also rising from 267 to 323, core also rising despite not having that oil component. So collectively, we're headed in the wrong direction. And if we look at gas prices nationally from AAA, we're at $3.88, and that's up from $3 end of February. So again, we're not seeing progress that we need to be making in the energy component that we had been baked in, and we had been sitting at that sub 2% inflation level for a long time. Another thing we're looking at as well is the prices of fertilizer, because in the Strait of Hormuz, it's not just oil that's being moved around, it's all sorts of petrochemicals, and that includes components of fertilizer. And right now the fertilizer index is rising steeply and dramatically, and this will eventually, of course, bake its way into food prices. And as we look at the technicals for ETFs, for wheat, for corn, just general agricultural ETFs, not only are those rising, but those also have a technical analysis component, a trend component that is flipping from bearish to bullish. So we're getting a TA bear to bull reversal just as we're getting this fundamental component where we're seeing restrictions on petrochemicals in the Strait of Hormuz. So it's kind of a double whammy. And from a TA perspective, that's what you want to see. But from a real life human living on Earth perspective, that's not what we want to see, as we're seeing inflation, again, headed in the wrong direction by many metrics. The concern here is that the Strait of Hormuz situation is going to persist. The longer it persists, the worse things get. The higher gas prices get, the more likelihood of restrictions globally, less so in the US, but we're already seeing some of that in Australia and Asia, for example. Also looking at the GDP component from the Atlanta Fed, GDP now has turned down slightly. It's still above 2% on the estimate. a lot of the recessionistas who were crying recession, recession, recession for many, many quarters did not have the data to support that ultimately. But now, again, because of the oil shock, it is potential that we will see a NBER declared recession, where we're going to get a back-to-back 2 quarters of negative GDP. Certainly possible. Certainly possible. So moving on to charts, the big problem here is obviously yields. It's dollar, it's VIX, it's the MOVE index, which is the VIX of the bonds, and a rising bond component. So we're seeing the dollar still sitting sub 100, but again, technically on technical analysis, that's not something we want to see breaking above 100, as we have a multi-month wedge situation sitting here ready to break out. So if this were any other chart in a vacuum, you'd say, okay, here's the level, it's at 100, that's the horizontal, anything above that, and we expect positive momentum far above 100 at that point, likely to 105, because that's the depth of the pattern itself. So to see dollar rising, to see yields rising, also possibly played a component of why President Trump went out and maybe fibbed a little on what exactly was going on in the Middle East and sort of caught the market off sides. Today, we have the 10-year still at 4.38. So the diminishing returns of taco are certainly hitting the markets. And at some point, if this gets above 4.5, 4 3/4, 5, there's going to be another different type of intervention. But until then, we're in this unease, uncertainty period where risk assets are likely to see significant headwinds, which, much like agriculture and food softs, as it were, are seeing this bear to bull reversal. Legacy markets are seeing a bull to bear reversal on technicals. And all this, of course, matters because crypto isn't usually spared from that. And crypto has held its own down here. But getting back to the yield component, to see yields rising like this in the face of everything is certainly not bullish for risk assets. And everyone is paying attention to that, attuned to that, and aware of that. And flipping to the SPY is now below my favorite technical indicator, which is the daily cloud. It's been below the daily cloud for over a week now. It's been through the daily cloud for over 2 weeks. It has been trying to put in a topping pattern for quite some time. And it's also below the 200-day moving average. Nothing good happens below the 200-day moving average, and nothing good happens below the cloud. And much like March, April 2025, the expectation here, again, based on technicals, should be downward momentum and lower lows with very little, bounce potential. That's just the expectation. That's the trend that we're headed in, and we at this point have a fundamental component with oil and yields and uncertainty to support that downward momentum. And the Q's much of the same, again, below the cloud, below the 200, headed for what looks to be lower lows after trying to put in a topping pattern for months. There was this him and haw about whether or not we would get this head and shoulders pattern breakdown. It looks very real on things like Google. It looks very real on things like NVIDIA. And if the best companies in the history of the world are putting in topping patterns, then it is very likely that the Qs are going to roll over as well when that impact finally hits the indices, and of course the SPY. SMH, again, no different. We're seeing similar here with the head and shoulders topping pattern. And that's okay, that's fine. This is after months of almost literally a 45-degree angle straight up, going from 200 to 400 on the SMH. But if we're looking for things that correlate with crypto, things that on the risk spectrum generally support crypto, all of those boxes that we need to check are again headed in the wrong direction, and that might just be the title for this video, where we are just headed in the wrong direction on trend, on inflation, on yields, on rate cut expectations, etc. And also, again, the Mag 7 ETF broadly also has been in a bear trend now for a few weeks, below the 200, below the cloud. We're just seeing a general rinse of momentum names that had been really strong post the tariff tantrum, post April 2025. And that is again, it's going to affect BTC and has affected BTC. It has affected everything down the stack, everything down the risk spectrum as well. And if we look at BTC today, it's still in this questionable state of most certainly a bear trend. Is there a pattern here to support bearish continuation is always my question. We've now sat in this consolidation zone since February. We've actually fared far better than legacy markets since February. But the problem, of course, is we fared far worse than legacy markets since 10/10, since October 10th. We essentially went straight down, BTC down 50, 60%, alts down 60, 70%, some alts down 90%. Those have yet to recover. So the difficulty here as a crypto trader, as a crypto investor, is how do you know enough's enough? When do you know when to step in as a trader? When to take your shot, right? If I'm looking at this chart today, potentially, again, it's all sorts of things, and that's the issue. It is clearly still in a downtrend. It potentially has, shades of an inverted head and shoulders with a diagonal neckline. It potentially has this bear flag component, just like we did from November, December 25. And it's very much just a wait and see if this, then that, if I'm trading this in the near term. If I'm a longer term investor, I'm loving this opportunity as a dollar cost average opportunity. I'm loving lows. I'm loving seeing this go lower. I'm loving the bearish momentum. That's what you want to see if you're a dollar cost average investor. But if you're trading this or you're holding this, you're obviously eating some pain since October. That has been unrelenting. And again, now the problem is, even after we've tried to bottom a couple times under our own power, this massive mega headwind is blowing in our face. And the question I have to ask myself is, okay, as a trader, do I want to be long this market if I'm super bearish, the SPY? There's fundamental catalysts that may push SPY lower, and VIX higher, oil higher. Generally the answer to that question is always going to be no. This is just not a time to shoot your shot, wait for a better pitch down the line, is most likely what many people are thinking, and probably why crypto is just sort of stagnated here and hasn't really done much of anything. And in a bear market, in a bear period, altcoins are also generally just correlating one-to-one with the market, with BTC. There have been a few alts that have done slightly better. The first one I'd like to point out would be Hype. Hype is a token for a decentralized exchange. Hype has done well recently because it has traded commodities 24/7 and has been able to trade oil 24/7 and has been named and mentioned in many articles in TradFi. All of the metrics for usage are up and to the right. We just saw, I think it was it 64,000 or 6,400 new users in a day a couple days ago. So they're just continually setting the bar for user activity. Now that doesn't mean that people will buy the Hype token, but it is part of the package of being on that exchange. And if oil is going to remain super hot from a trading perspective, and if people are going to be looking to trade oil somewhere 24/7, one of those places that everybody is starting to get to know is Hyperliquid. So when I look at the Hyperliquid chart for the token, again, it's one of the few charts that actually has a bullish trend. It's above the cloud, it's above the 200, and it looks like it wants bullish continuation. And that is surprising in this current environment where we have none of that. As a technical analyst who prides himself on pretending I'm on a deserted island when looking at charts, BTC is still not there yet. It's still very much in a bearish stance, in a bearish position. But if BTC were to flip the corner there, again, as a trader, that would be good enough for me. It would be likely that I'd be sizing that down. I'd be taking profit earlier on that position, et cetera, but I still think it'd be worth a punt, whereas currently not the case. Hyperliquid very much is complete opposite of everything you're going to see in the market right now. And generally when something does better in the face of this amount of bearishness and the market turns bullish, that asset does extremely well. So that's also something to watch for going into the middle of the year and towards the end of the year. If we get out of this quagmire in the Middle East, this boondoggle, whatever you want to call it, it's very possible that Hype does extremely well towards the end of the year. And we can also look at something like Hype BTC, which had a cup and handle chart pattern that it's breaking out of as well. And to outperform BTC as an altcoin has been extremely rare. and hasn't really been seen in the market for quite some time. But looking at the hype BTC chart, it is very, very strong, continues to be strong relative to BTC, no question. The only other alt I would point out here from a technical perspective would be Tau, T-A-O. Tau is kind of on this AI agentic bandwagon where it has the ability to spin up these subnets. That's not what they call them, but that's what I'm going to call them, where agentic services can take action, right? And again, we're seeing not exactly the same amount of bullishness from a technical perspective as hype, but very, very similar positioning where you're seeing continuous higher highs here on Tau, and it's now up 120% since February, where most alts, Bitcoin, are not. So there is a very minimal amount of dispersion, I guess you could call it, or differentiation here between some of these altcoins. But when we look at the top of the stack, when we look at things like ETF flows week over week, those have been fairly mild to negative for BTC, ETH, Ripple, Sol. When we look at things like the CME COT data, the commitment of traders positioning, that is still, in my opinion, very heavily skewed with a bearish stance. Commercials are very short on BTC and ETH, and that is not what you want to see for a bullish trend. And couple all of this with, of course, the macro stuff that continues to just blow headwinds in our face. It doesn't seem to be a very good time, a very appropriate time for risk assets across the board to do well as alts, as well as BTC and ETH. So generally, you know, this as a trader, this is a wait and see moment. As an investor, as a dollar cost average enjoyer, not financial advice, but this is a time where these types of individuals are celebrating their dancing, right? We're down 50, 60% on BTC. You've got SPY rolling over. These are excellent opportunities to just continue the plan, continue the long-term DCA. And what I'd like to see going forward here is obviously a resolution in the Middle East that would help assuage a lot of these concerns with yields, VIX, move. If that doesn't happen, which it certainly doesn't look like it will today on March 24th, then things may need to get a lot worse before they get better, is pretty much the takeaway. Yields will certainly keep rising, most likely, and you're going to see more extreme types of intervention. And one of the wild cards to watch for on oil is if the Treasury, if Besant is actually shorting oil here, then man, watch out when that snaps, whatever level that may be, 100 or higher. But we're at a very, very uncertain time in an uncertain place.